What is up, guys? Welcome back to my YouTube channel. My name is James Pakyon and this is Pakyon FX. So guys, I know I haven't posted in the longest time. I think it's been over 3 weeks. I haven't done a video but I have been very busy with stuff, so I apologize for staying away without posting content. Also super grateful to all the new subscribers that have joined in. I remember the last time I was here we were under 100 subscribers, but right now we are at 182 if I'm not wrong. So super grateful to the new subscribers. The family is growing bigger, and I hope that all the content that I post on here is going to assist all of you guys to be able to advance in your trading career. So guys, today I am back again with another educational video, and I have been observing us beginners and how we deal with our forex trading journey, and so I came up with this topic, and I am hoping that you're going to learn a thing or two. So let's get right into it. Today's video, as you can see on the title, we are talking about why most beginner traders fail in forex. And I know this is a common thing because it's actually said that 90% of people who start trading forex actually end up quitting. So these are some of the reasons that I have gathered that I think might be the reason why people end up failing in trading. And so let's just get straight into it. So number one is a gambling mentality, and I'm going to say this over and over again. In forex, it's not a get rich quick scheme. If it was, then everybody will have become a forex millionaire, but it is not a get rich quick scheme. So don't get into forex thinking that you're going to make millions after 3 months, because that's what most people think. I actually did a video on blowing my first account, and I told you guys how, after coming from a demo account, how I thought that I would flip my 100 USD into something huge like 1,000. I ended up blowing it because I was gambling. I was actually gambling. I wasn't trading. I wasn't doing analysis. I was just taking random trades with the expectations that they will go my way. But unfortunately, that's 90% of the time that's not what happens. You will end up losing money. So stop treating trading as a gamble, and start treating it professionally as an investment. So you need to calculate your moves, know when to enter your trades, and then profit from that. So number two is over leveraging your account, and we've talked about leverage before. So when you're registering with your broker, you need to select a leverage. Rather, it sort of amplifies your account, because you know, with your small amount of money, it's not really logical to buy from the bigger forex market. So the broker provides you with a leverage which allows for you to be able to trade with a much bigger capital size as compared to your account. So most brokers actually offer a leverage of up to 500, that is 1:500, but some go all the way to 1:1000. So the thing that you will notice is the higher your leverage, the bigger the moves in regards to when your trading is fluctuating. So the bigger the size of the amount that is moving for every pip. So always select a leverage. If you're a beginner, just select a leverage that suits your account. Don't over leverage. Don't go and take a 1:1000 account. You could start with 1:200 and then progress from there. So number three, and this is something that is very common, it's using improper lot sizes. Improper positioning is a huge factor when it comes to trading, because your lot size dictates the amount of money that you're going to win or lose when the currency moves a particular when it moves a particular number of pips. So most traders, you start off, say, with your $100 account, and you go in on one trade on lot size 1. And let me tell you what this does. For every 1 pip on lot size 1, it's equivalent to $10. So if that trade goes against you 10 pips, then we all know what happens. Your account is blown. So avoid using huge lot sizes, improper lot sizes. Don't put your trades that you've put a 0.03, you've put a 0.07, you've put a 0.33, 0.1. It's good to decide on a particular lot size and only move from that lot size once you're confident that your trades are going, or rather you've become more consistent. Another factor that faces beginners is the lack of journaling your trades and not backtesting. So backtesting basically refers to looking back at your charts and looking at the trades that you've taken, and now that the market has already formed out, it gives you a much better understanding, or rather you will analyze what exactly you saw when you decided to take a particular trade. And this enables you, backtesting enables you to be able to polish up your strategy, to be able to know that this particular, whenever I choose to enter a trade after this particular candlestick formation or movement, it always ends up in profit or loss. So it enables you to be able to see which practices in your trading make you money and the ones that don't. So you can be able to polish up your strategy as you go. Journaling, on the other hand, requires you to write down all your trades. Every trade that you've taken, write it down. How I journal my trades, it's the date, the currency pair, the lot size, and whether it was a buy or a sell, and then how many pips I have won or lost, and then the amount of money that I have gained or lost. So I usually divide my journal into those columns, and then I fill out every time I take a trade. So that enables me to, when I look back at my trades, I see, for example, this day I was down this number of pips, or this day I was up this number of pips, how many trades I took this particular day, and basically that enables me to be able to polish up a strategy that fits my personal style. So that's another thing that is very it is very important to consider. So another thing, it's greed, and greed is going to kill you in the market, because what greed does, when, for example, you have a trade that is going your way, you don't want to let one position run. So you find some people, they end up stacking, and it's not a bad thing. If you're sure of your trade, it's not a bad thing, and if your account is good, it's not a bad thing. But if you end up stacking too many trades, and then say your move is at actually the end, when it reverses, then even the profits that you have made on the much earlier trade, they're going to be wiped out. You're either going to close in a smaller profit, or no profit at all, or even in loss. So greed is one thing that is supposed to be controlled by every trader. So just know that this is the amount of trades that I'm going to take this particular day. If, for example, you've closed out positions and you haven't really reached your daily target, and you feel like you need to get into the trade after you've actually made some money, sometimes you find that you go back, take a trade, end up losing. So you either lose part of the profits that you've taken, or even go back into a drawdown. So it's something to consider. It's personal, but if you're able to control the greed in the market, then I can assure you that you're going to actually grow your account more. So the sixth factor is fear of missing out, and fear of missing out occurs when you have a late entry, or rather you've identified that there is a particular move, and then you find that move has already gone, but you don't want to miss out. So if, for example, there's a breakout, you want to chase the breakout. If there is a retest, you want to take back the trade, go with the momentum. Unfortunately, sometimes the momentum might have already moved, or rather passed, and you're entering the trade too late. So your fear of missing out might result you into entering a trade that will go into profit, but maybe a very, very few pips. So maybe like 10 pips, and then finish its momentum, end up coming back, and at the end of the day, you know what happens. You're going to go into a drawdown. And if, for example, your stop loss was like 2 or say 10 to 15 pips above your entry, then unfortunately that trade might be taken out. So number 7, it's using too tight stop loss or no stop loss at all. And this is something that I have personally identified in most beginner traders. You find that people open up positions in the forex market without setting a stop loss. If that trade goes against you, it might end up, say, moving like 50 pips. A person who had set their stop loss at 20, 25 pips will be taken out, yes, but they will be taken out with rather much lesser money as compared to someone who doesn't put a stop loss and the trade is already at negative 50 pips. So now you have the decision of either closing or waiting. If you wait, it might end up going even more negative. But if you close now, you're closing with even more loss as compared to someone who had set a stop loss. So advisable to open a stop loss. That is actually the number one thing that you're always supposed to be doing every time you're opening a trade. So if you open a position, make sure you have identified your stop loss and your take profit, so that if the currency pair moves, or rather the price moves up to that point, then it takes you out with either your money or with a small loss. Setting too tight a stop loss refers to when a trader, say for example, is taking a trade and then is setting a stop loss of like 5 pips, 10 pips. I mean, it's a good thing, but if you've not really caught the move at the very top, if for example that pair reverses, which is very common, reverses a little, then ends up going your direction, then it means that you will have lost your money. So always well to observe where the candlesticks, or rather the previous formations are, and set your stop loss slightly above, like 5 or 4 pips above the, for example, the lowest low, if you're taking a buy trade. So number 8, which is now second last, is targeting too many pips. Targeting too many pips refers to targeting like a big move. Sometimes you find that the currency pair isn't really going to move that much. Maybe during the day it might move like say 30, maybe 20 to 30, or maybe at most 50 pips, and then reverse. But some people will be targeting like 100 pips during the day, and you find that the trade goes your direction like 50 pips, then ends up reversing, will hit your stop loss, or you will close with a much smaller profit. Unlike if you had set your take profit, say like 40 pips, you see, at the end of the day you will have been taken out with some profit. So targeting too many pips as a beginner is also another way that we fail, because if you aren't experienced yet and you're not doing something that is called there is a day trader, if you're not swing trading, then just target small pips. It is much easier to actually accomplish those. And lastly is trading everything. Trading everything refers to when you're trading like 10 currency pairs, you're trading oil. If you look at your trading view, you have oil, you have gold, you have Bitcoin, you have 10 currency pairs. You're looking at all these things, you're trying to take trades in all these things. As a beginner, this is too much information. It's actually going to clog your mind. You're going to get something that is called analysis paralysis, such that when you look at a trade, you don't know what to do. Or rather, when you look at the charts, you don't know what to do. So if you're a beginner, I advise you to rather narrow down to your most favorite pairs For me, it was GJ and GU. Right now, I'm only trading GU. So I have decided to focus on only one currency pair, master it, know all the movements, and I can actually assure you that we can make your money perfectly from only one currency pair. You don't need to trade 10 currency pairs, 90 indices. No, you don't need that. Actually, if you observe some traders, some traders actually only do, like QBanks. There was a time QBanks was only trading USD JPY. Right now, I think he's only doing US30. There's a trader that I know is called Drewise Banks. He only trades GJ. Some traders may say they only do indices, and that is NAS 100, only NASDAQ 100, and they make a killing from that one index. So you don't have to trade everything to make money. Focus on one pair, master it, know everything about it, and trust you me, you're going to make money. So I am hoping this video has been helpful to you guys. And if you haven't subscribed yet, please do. Click the subscribe button for more of these updates, and also click the like button if you haven't already. And I will see you guys in the next one. Peace out.